Hey everyone, welcome to Dividend School Live. Today we're going to talk about five dividend stocks that are trading at their 52-week low or near there. But here's the twist. We're not going to talk about them as a five buys. Each of these gets a different verdict from me, and one is a great company I still won't put on my universe. One's already in my universe, but I'm not buying today. One's a great business at almost the right price. One is a flat out cautionary tale, and one is a turnaround coin flip. But at the end, you'll have a repeatable way to tell a bargain from a trap. So, some of the companies we're going to talk about today: Accenture, Microsoft, McDonald's, Pfizer, and Nike. So let's dig in. Okay, so maybe you're asking why would we look at companies at a 52-week low? There's kind of two reasons. Number one is when a stock drops that low, sometimes there's a reason. Sometimes the company is not performing well. Sometimes the financials are terrible. Maybe there's some catalyst that didn't come through, things of that nature. And these could be a great opportunity to bargain hunt. I am, after all, a value investor at heart, and I like, as Warren Buffett says, I like my stocks like I like my socks on sale. So this is an opportunity we have to sift through and try to find the companies that could be potentially a great fit for our portfolio. So that is why we're looking at these companies at 52-week lows. So here are the five names. As I mentioned earlier, we have Accenture, which is strong, but right now it's outside of my universe. We have Microsoft, which is in my universe. I've actually owned this company since 2013, but right now I don't feel like it's a buy. We have McDonald's, good business, maybe wrong price. Pfizer, which I believe is a cautionary tale, it's a yield trap. And Nike, which is functioning as a turnaround. It's a brand versus a broken model. And as Warren Buffett liked to say about turnarounds, they don't often turn. As we work through these five companies today, we're going to ask the four same questions. We're going to ask about the business quality. We're going to try to find it obviously very high on the priority list. So we want to make sure that the payout is covered by the cash returns. We're going to look at ROIC. So is the capital compounding well? And number four, finally, is valuation. So we want to read the margin of safety and see if there is a value gap between where the company is trading and where we think it should be trading. All right, so let's dig in to the first company. So let's look at Accenture. Why is Accenture here? So Accenture, if you're not familiar with it, is the world's largest consulting and IT services firm. Right now, it's trading at about five and a half, a little over 5% off its 52-week low, which was the price is around $124. It is yielding 5.2%, so that's obviously very attractive. You may be asking, why is it down? Uh, Basically, it's down because of AI fears. AI can let clients self-serve work that once was needed by Accenture consultants. The Q3 bookings fell 3%, the first drop in years, and the stock is down 60% from its high. So I guess the question is the market overreacting or is it right? So let's kind of take a look at the numbers and I'll give you a little bit of anecdotal information as well. So as we dig in, the numbers. So here are the four questions. The dividends, as you can see, are compounding nicely, about 13% a year. We love that. The free cash flow payout ratio is just 35%. So the dividend is well covered. ROIC is still 24%, although we could see it after peaking in 2022. It has continued to steadily fall. So even though the ROIC has fallen, it is still greater than its WACC or its discount rate or the cost of capital. And so that gives me, I guess, a little bit of encouragement that this could be still a quality company. The valuation is really what has dropped. So the 5-year average for the PE is 27 times earnings. Right now, it's trading at 10 times earnings. So that is quite a substantial drop for the company. The revenue is not growing really fast. It's not a fast growing company. That's one of the things that you have to, I guess, wrap your head around and be comfortable with, is that this is not going to be a 10, 15, 20% grower. This is going to be a 3 to 5% revenue growth company, but it is highly, highly profitable because of the nature of the business. And as we can see, it is covering the dividend quite comfortably with the payout ratio for free cash flow. So if we look at the, I guess, attempted valuation, I feel like the fair value is trading around $179. Today's price is around 125. So this is a very, very strong company. There are real questions about the AI scare that are going on that I want to understand more deeply. This is a company that, I'll be honest upfront, I do not own, and I do not know it as well as maybe a few of the other ones on the list. And so that is one of my big hesitations before I go ahead and put it on my dividend universe as a company that I would want to put in my portfolio and be comfortable recommending it to everyone listening. So that being said, one thing I want to, I guess I read this anecdote on X. Yes, it is still functional. And I read this anecdote not too long ago. I got a few days ago, and it still kind of is sticking in my head. So AI obviously can impact a company like Accenture because the capabilities of AI are ridiculous, and the things that it can do are amazing. And so, one of the things that's happening is that there are real use cases for AI in business. But there are some places where you are going to need to use a company like Accenture. So, for example, I believe it was Kroger recently approached Accenture about improving their website. So, the ability for people to buy online, developing an app for their customers, and those kinds of things. And so, what ended up happening was Accenture basically took it from uh, a not just creating an app, but they took the whole process and did everything for the business online, or for themselves. So they did everything. They created the app, they created the online presence, they created the quality of the online presence, and they did everything from start to finish for I believe it was Kroger, and so everything was done, from handing over the keys to giving the business a finished product and maintaining that finished product once it was done. And while AI can probably do some of those things on its own, the business, again, Kroger, would have to pay somebody to monitor all that. They would have to pay somebody whenever it breaks, and inevitably it would break. And all those things have to be done. And so Accenture takes that off the table for a business like a Kroger or some other business. And that is one of the things that Accenture can do. Is Accenture using AI to do some of these things? Probably, most likely. But the point of the matter is that Accenture offers a kind of one solution for these large enterprise businesses that don't really have the wherewithal or really the time and money, really more of the time to really focus on this for one person. And because it's such a large deploy for a business like a Kroger or any other business, that they really need to have this more outsourced as opposed to insourced. And so that is one of the ways that Accenture wins in what it is that they do. And the AI fears obviously have really impacted the business. And just like Adobe, this smells a lot like Adobe. And I don't really have an opinion on Adobe one way or the other. But Accenture is a company I'm looking into, and this is something that I am going to have to wrestle with and come to terms with. All right, so let's move on to the next business. So we have Microsoft. So everybody knows Microsoft. Everybody's familiar with this business. It's again a company I've owned since 2013. It's around 4.5 to 5% of my portfolio. So if I was going to add to this company, even though the price is very attractive right now, I would want a better opportunity price wise, and we'll talk about that. So, Microsoft is easily the most valuable software franchise in the world. Right now, it's trading around 6.8% off of its 52-week low. So it's not at its low, but it is in the range. The yield has come up. I wrote about this recently, and it was 0.9%. I believe it was actually 0.86%, and it's now a little over 1%. So that obviously is great. The reason why it's down is AI capex is racing towards 130 billion a year, and it's crushing the free cash flow. The free cash flow margin has slid from 33% to 25%, and that is expected to go up. And there is some concerns that Microsoft might not be able to cover all their operating expenses with just their cash, which would be a first for the business in a very, very long time. And so this it's appearing that this is going to be a very capital intensive business, at least for the short term, as everybody tries to win the AI race, so to speak. So I guess the question that I would ask you, do you believe that the market is overreacting or do you think that it's right? So let's look at the numbers and answer our four questions. So the four questions. So the dividend is very strong. Dividend has had 20 years of dividend hikes of 10% or more. And so that is obviously awesome. The ROIC is still 24%, but as we can see from the chart here, it has slid from the high 40s, so what, 46% down to 24%. So that is concerning, but that all again ties directly to the AI capex spend because as the company spends more and more money on capex, that is definitely impacting the operating income of the business and the free cash flow. The company right now is trading at a PE of 22, which their norm is 32. So that really it's showing that this is possibly a great opportunity. As we can see, the revenue is growing fantastically. So they're growing 14, 15%, which for a company that's over 4 trillion or 5 trillion, I'm not sure the exact market cap. Trading generating that kind of revenue at that kind of size is kind of mind-boggling. But as we can see, the free cash flow has been pretty flat. And again, this all ties directly into the capex. All right. So if we look at the verdict, if you will, it is trading below its current valuation. And so that does, on the surface, it looks like it could be a fantastic opportunity. But the big, big but is the capex. And as the capex continues to rise, as the company tries to stay relevant in the AI race, they're going to have to spend more and more to stay relevant. Companies like Meta, Google, Amazon, the Open AI, Perplexity, all these companies are spending Anthropic are spending, a buku money, lots and lots of dollars, to try to stay in the race. And as that continues to go up, we don't know what kind of returns we're going to see on that spend. And that is one of the big, big concerns with Microsoft. And I think over the next few quarters, we will probably start to get an answer on what kind of returns we could get for that. So if you are looking at Microsoft and you think this valuation is just too juicy to pass up, I wouldn't blame you, but I would probably encourage you to maybe take a smaller bite, maybe a 0.5% or 1% of your portfolio as a bet against whether the company can, if you're right and the company does generate market beating returns, their ROIC starts to creep up, then that's going to be a fantastic investment. If it doesn't, then you're not out that much. So that's kind of how I would look at Microsoft. Again, I'm in a little different position because it's a bigger portion of my portfolio, but that's kind of what I'm looking for. So I guess for all the big AI companies right now, that's really the big concern with all of them is what kind of return are we going to get on that investment for the capex? All right, let's move on to the next one. McDonald's. McDonald's, business number three. Most people have heard of McDonald's, I believe. It's a worldwide brand. And why is it here? So it's a 51-year dividend king, which means any company that pays a dividend, consecutive growing dividend for over 50 years becomes a dividend king. And so this is one of the fast food, giants of the world. Right now it's trading at 2.7% off of its 52-week low. So the price is around $272. The yield is 2.7%, which is pretty good for a company like this. And the reason why it's down is traffic right now is soft. and management is flagging pressure on the low income consumer. So, as inflation has risen, especially the gas prices, that has put a lot of pressure on folks, and McDonald's is noticing that in their traffic. So, analysts have trimmed targets on the stock and it has drifted to multi year lows. So, again, a question we've asked for the other two companies: do you feel like market is overreacting, or do you think it's right? So let's dig into McDonald's and look at it a little closer. So our four questions. So if we look at the dividend per share, that chart looks like it's growing very, very nicely. The operating margins have stayed relatively consistent. Right now, they're at 46%. So that's awesome. The dividend, again, has had 51 years of straight raises. So that's awesome. It's showing an 18% ROIC, which is well within their norm. So everything operationally seems like it's just kind of chugging along. The only thing that's really not on sale yet is the price. And if we look quickly at the revenues and the free cash flow is fairly steady and the revenue is growing slowly. This, again, is not going to be a fast grower like we talked about with Accenture. This is a company that's going to grow 3 to 5 ish% a year, a little bit better than inflation, but not a whole lot faster. What you're really looking for is growth of earnings, with a lot of share buybacks and continued profitability of the business model, and continue to pay out that steady growing dividend, which is what a lot of people use McDonald's for, as in an income play. And it's a great company to look at for that. If you're looking at it for dividend growth, that's probably maybe not necessarily the place I would look. But if you're looking at it as a stable anchor to a portfolio, yeah, that'd definitely be good. So right now, the company's valuation is trading a little bit below its fair value. Right now, the historical PE is 22, or I'm sorry, is 22 versus their historic, which is 26. What I ideally would like to see would see that slide into the 18 to 20 times range for the PE. And I think with everything else holding steady, that would be, to me, a time to definitely buy into this. McDonald's is part of my dividend universe. I think it's a strong company. And depending on your risk profile and how you feel about the valuation, I definitely think it would be, I would not be, it would not be a bad thing to buy the company. I'm being patient and I'm trying to be a little more, I guess, hard line on it and waiting for it to get to the right price for me. So that's kind of my read on McDonald's. Let's next move on to a cautionary tale. So, the three companies we've talked about right up till now have been companies that I'm either interested in or are currently in my universe, but I want to give you reasons why I'm maybe not taking a bite of those right now. Pfizer is not in my universe. And frankly, it's not something that I'm actually really interested in, but I thought it would be a good cautionary tale to look at as a company of what to look for and not choose to buy it. So obviously the juiciest part of this is the yield. It's trading at 7.1% dividend yield, which is very high and will definitely attract a lot of dividend investors. The company is trading at a 3.9% off of its 52-week low, so it's around $24 a share. The reasons it's down is there's two reasons. Post-COVID, the revenue has fallen off a cliff, and it's also facing a patent wave. So it has two brands that are coming up on our patents: Eliquis and Ibrance, and a few others, which threatens up to 15 to 17 billion of revenue in the next few years. It also has $51 billion of debt on the books. And for a company that's trading around 137 billion in market cap, that's kind of high. That's a lot of debt to sit on the books. And so I guess the question we want to ask, right, is this overreaction, or is the market right? So let's look at the numbers. So the four questions that I would look at in relation to Pfizer. So the dividend is growing. It is barely rising. The big concern, the revenues have fallen off a cliff. As you can see from the chart, 2022 was at the height of the post-pandemic, if you will. And over the last 3 years, it has really kind of struggled. The valuation has definitely fallen off as well. It's trading at a 9 times PE right now versus its 5-year average of 14 times. But the thing I think that really stands out is looking at the free cash flow versus the dividends paid. And this is to me why the company is such a a great example of what to look for to avoid. If we look at the chart, we can see that the free cash flows have dropped drastically from 2021 to 2022. They actually fell below the dividend in 2023, and in 2024 and 2025, they've been pretty steady. The free cash flow payout ratio is hovering a little over 100%. And the earnings payout ratio has been hovering last year was over 130%. Those numbers are unsustainable. That is not what you want to see. And so the trap could be that it's producing more in dividends that is paying out, generating in cash flow and earnings. And that is unsustainable. And that is partly why the debt load is concerning as well, because the only way they can continue to fund that kind of yield is either selling equity of shares or raising debt, and to continue to fund the offset between what they're generating in profit and what they're generating in the payout. Because as we said in many times, the market hates nothing more than a dividend cut. And if Pfizer ended up having to cut their dividend, that would be a huge red flag to the market and a signal that there's something going wrong. And the market hates that, and the share price would tank very quickly. And that dividend yield that you're buying it for, you would lose that. And so that's why avoiding companies right now like Pfizer is one of the reasons why when you're doing your analysis, one of the first things you want to look at is if you see a yield that's really high, you want to ask, is that sustainable and is that real? And looking at the earnings payout ratio and the free cash flow payout ratio are one of the easiest ways to find and avoid companies that could be a dividend trap. We talked about AT&T in the past, and Pfizer is again another example or a great example of a company that I feel like is a dividend trap and I would avoid at this time. So if you look at the margin of safety, if you will, yes, it is definitely trading below its historical averages and what the analysts believe is a fair value for the company. The high yield is definitely a warning. It's not a reward, and it's cheap on paper, but the dividend and the pipeline both still have to prove themselves. And for me, it's a hard pass. All right. So the last company that we'll talk about of the five is Nike. So this is definitely a company that's going through a turnaround. I think most people are familiar with Nike and the swoosh, Michael Jordan, the tennis shoes, sports, yeah, everything. So this is easily the most iconic brand in the sporting world, and it's been cut in half. It's trading around 6% above its 52-week low, and it's priced around $42. Yields 3.9%, which is attractive for sure. The reason why it's down, it's had 2 straight years of falling revenue, and margins have been cut almost in half. Last week, the company reported a quarter four beat, uh, which was almost all a one-time 986 million tariff refund. So basically, it had nothing to do with operations. So the beat was a one-time event that is not air quote real. So what do we think? Do we think the market is overreacting to Nike, or do we think it's right? Let's look at our numbers. So if we look at the chart here, some things that kind of stand out that are very concerning. One would be the operating margin. We can see it's dropped from a high of 14% back in 2022 to 8%. That's terrifying. We also see correspondingly that the return on invested capital has dropped drastically as well from the high of 2022 to to the current rates, 18% and 45%. So yeah, very, very low. As we can see, revenues have fallen over the last 2 years, and the free cash flow has been pretty stagnant as well. So the brand is definitely intact. I'm not saying that the company is going to go bankrupt anytime soon, but the business is obviously in a struggle mode, and it's kind of in mid repair, if you will. And one of the things that I mentioned at the onset is turnarounds. Warren Buffett likes to say turnarounds don't often turn. And that's really true. And if you look through the history of companies that have been able to successfully execute turnarounds, the list isn't long. And so a company that springs to mind that's most recent would be Microsoft. And that's a company that was able to execute a turnaround and has rebounded and is now one of the top companies in the market. I am skeptical on whether Nike will be able to do that. They have gone through several CEOs over the last few years because they are trying to turn around the business. They're on the struggle bus because their big growth avenue was China, and that has not panned out as well as they would have hoped. They've also fallen behind in the design of their shoes, and there's just a heck of a lot more competition out there than there was years ago. And so they changed different kinds of things with their operating model. They tried to shift to more of an online operation, and that didn't work out well for them. And so they just had some struggles. And so I'm not saying that this is a bad investment. I'm not saying that this would be a company you should absolutely avoid, but I would definitely encourage you to dig into the numbers and think about strongly about what you think the future of this company holds. And if, again, like with Microsoft, if you were going to take a bite of this because you think it's too attractive to ignore, I would probably encourage you to take a smaller position size of the company until you see signs of the market starting to until you see signs of the business starting to affect a turnaround. And it all comes down to execution. That's really what it's all about. Great management, great execution leads to great companies. And right now, Nike is struggling in that arena. So if you look at the margin of safety, if you will, we can see that the company is trading a little bit less than their fair value. Right now, their 5-year average is 29 times PE, and right now it's trading at a 20 PE. So this is definitely a strong brand, but it's in the repair mode right now. So it's cheap versus its history, and you're paid 4% for a yield to wait, but my concern is the turnaround is unproven. So today it's a bet on the brand, not on the numbers. And so you can act accordingly with that. All right. So that kind of wraps up our discussion on all the companies. So here's a scorecard you can take away to kind of look at what we talked about with the companies. You can see the yield, the free cash flow payout ratio, the ROIC, the PE versus their average, and what I believe is appropriate response for the businesses where they are right now. So if we went, air quote, dumpster diving, that was a term, I'm 59, so that's an older term, I'm sure, but we can see that some of the yields are very attractive. But if you look at the free cash flow payout ratios, a few of them are not so great. The ROICs across the board are decent, which indicates that these are fairly quality businesses, but they're all trading at well below, in a lot of cases, well below their average PE ratios. And I think that Accenture, to me, is probably the standout in this category of a company that I definitely want to dig into and learn more about. Microsoft and McDonald's are two companies I own and are interested in, but I want to wait for a better opportunity price. And Pfizer and Nike, to me, are avoids at this time. And I guess that's